Okay, welcome everyone. We'll start our lesson 4. Today lesson will go through LO4, learning outcome 4, be able to recommend effective long-term and short-term sources of finance, sources of funds, where the money will come from for the business. So, and we have to manage. We have various options, and always in a business world, especially, we have to manage different sources of finance. It has short-term and long-term impact on our organization and the sustainability of organization. My name is Anjum Satar and my email address here. If you have any question, you can drop me. Before uh, starting today lesson, let's recap what we learned during our last three lessons. So anybody remember anything from last three lessons what we learned? So recap. So we'll start lesson 1. Anyone remember anything? What we learned?
Costing.
Brilliant. Costing system. Thanks. Great. So costing system, AB, cost behavior. Excellent. Great. Well done. Cost behavior. Job cost. Excellent. Absorption cost.
Marginal costing.
Method of costing, we can say, or we can say marginal costing, one of them. We discussed process costing, job costing. Okay, so that's all we learned during lesson 1. So what about lesson 2? Anything you remember from lesson 2?
Financial statements.
We learn about financial, so we can say financial statements. What those are?
Well then, statement of equity. There was statement of balance.
Statement of comprehensive statement, which is also known as profit. Well done. Come on, I am stuck in. So that's statement of financial position, statement of cash flow, and statement of change in equity. Okay, these are the statements. Good morning, welcome. Okay, these are the statements. We learn about ratios. We learn 4 types of ratios. Anybody remember what those were?
Variable, semi-variable.
No ratios. 4 types. We discuss profitability,
gears,
liquidity, use of resources, also known as efficiency, and gearing ratios. Yes. And we discuss next and M&S, Marks and Spencer financial ratios. Okay. What we learned yesterday lesson 3. Anybody remember what we learned?
Budget preparation.
Excellent. We discussed about budget. And do we know types of budget? We discussed incremental budget. We discussed zero-based budget. We discuss rolling budget and different types of budget. So we discuss variance, and we discuss what else we discuss. We zero based budget variance. Yes, so these different types of, yes, we discussed sale budget, of course. We discussed ABC activity based, ABC budget, activity based, ABC activity based, and activity based costing budget. Okay, that's, we discussed, these were the key points really up to now we have learned. So today lesson is lesson 4, and key command verb is assess. We have to assess when somebody say assess something, so offer a reason, a judgment, and quality of the situation. You have to look around. Reflect and appraise, appraisal, checking the performance of something, and justify which sources of finance is better. So what current your knowledge about sources of finance, please? What do you think? Where you up to? Current knowledge about topic. Do we know where we can get the money from? Please. Okay. Always good to be reflect, yes? Reflect where we are and where we'll be. Okay, so first of all, 4.1, we're looking at assess the needs of short-term working capital and the long term. First of all, what is meant by short term? Yeah, short term is a less than a year. So anything less than a year, you need a money for less than a year. So that's the short term. Short term sources of finance is short term sources of finance is we call. Okay, sorry, I mute you and it's due to the background. Okay, so 4.1, we need to be short term. Short term is mean less than a year. If we need money, such as bank overdraft, you can make arrangement with the bank for the short period of time, paying the fees, and we can get the finance for short period of time to meet. Long is more than a year. Yes, it varies industry to industry, but more than a year we normally say long term. Okay, hardest part of the starting business is raising money. If you want to start a business, become your own boss, that's the hardest part. If you don't have your own money, the entrepreneurial great ideas, clear ideas turn into the success of the business. You have ideas, you have experience, but you don't have a finance. So how insufficient fund can't be raised? Yes, sufficient fund we can't. So we need to look around what option we have. It is unlikely the business will get around. So we need a money. Careful planning for it. Not you borrow money heavy interest and you start a business, you put your money, you borrow money from the bank, and after 6 months your business won't run and your business dissolve. So that's not fair, guys. We need to be make sure if you want to become your own boss, you have a good, you maybe observe yourself. Lot of businesses fail in the first year. Even within first 6 months, they start and stop the business. Business need passions as well. Business need money. You have a money to meet your current expenses, your own expenses. When and how long finance is needed. So that's we need to be. What security can be provided? Whether the entrepreneurial is prepared to give a some control. Setup costs we always need to be keep in mind. Starting investment in capacity, fix and flex. Working capital is known as the running capital, which we need to meet the needs of the current business. So that's we need to look around. Okay. So types of ownership. Anybody knows if you want to start a business, how we can start a business? We can start as a sole trader. Okay, so sole trader is 1% business. You can look around how much money required, easy to start. There is no legal requirement. Then we have partnership in UK. We have Partnership Act 1890. If we don't have a written agreement between partner, we share equally. Limited company, it can be public limited, private limited, or you can start a business non-profit such as charity. We always set the missions, visions, values, corporate objective, and we need money for it. So working capital cycle is known as debtors mean our credit customer, trade receivable, credit sales, credit customer, inventories, turnover days, trade payable, yes, which credit for 90 days. So there should be, we receive money quicker from customer and we pay longer to our suppliers. So in the all this is shows if you calculate the receivable days plus inventory turnover days minus, so it shows one cycle working capital cycle. So last lesson we learned about the ratios and we can calculate these, turnover days and by using the ratios. As sources of finance, a business has the variety of choices where we get the money from. So always we need to be a business need to assess different types of finance based on the criteria, amount required. So please always when we raise the money, we need to be look around which source of finance is better, how much is cost, for how long we require the money, amount of money required. So we need to look around. If we require 10,000, we getting 50,000. That's the waste. We don't need it. So we need only what we have a requirement. That's why yesterday we learned about the cash budget. So in the cash budget, we learn about how much each month is required and how much we have a surplus, how much we are under like we learn in November and December was short in the cash, so that's why we need a cash to meet our running expenses. How quick the money is needed, that's other the point or the question we have to ask in the business. Okay, the cheapest option. Okay, you have to look around which one is the cheaper option. We can or shares, we can issue shares if we are a company, public limited company, or we can borrow money from the bank. Anyone, which one you think will go ahead? We issue shares. Shares is known as a equity finance. Equity, yes, shares or borrow loan. What do you think? This is known as debt financing. What do you think? Which one will go? Anyone? Shares. Why shares? Why shares? Yes, you maybe can say shareholders. We don't need to pay fixed rate. Yes, we pay dividend if we earn the profit. If we don't earn the profit, we don't pay the dividend. Dividend is means the return. But think about if you are a shareholder and you're taking lot of risk. So like yesterday we discussed Bitcoin is $12 to $20,000. Yes. Okay, we think is a less risky. Okay, think about you're a director of the company. Yes. Let's say you're a CEO of the company, you've been selected in a public limited company, but the shareholders can, through voting right, they can change, they can replace you. That's one risk there in the shares. Okay, in the shares, they normally people expect more than 10% return, because bank give you only, you can borrow money through bank maybe 3% 4% interest rate because in the UK we have a base rate 0.01% basic interest rate, but in dividend holders we have to pay 10%. Okay, other disadvantage to issue shares, uh, dividend we paid on profit after tax. But if we have loan we can get 3% on interest rate, and is the interest on loan will be considered as expense, and this will be minus from profit and loss account or the statement, profit and loss statement before tax. So it means we will save on tax. That's other benefit. Only the drawback, if you can't afford it to pay back to your bank can maybe claim your properties, yes, your assets, but the shareholders can't. So loan is debt financing is cheaper than equity. So that's why, but you're absolutely right. In that sense, equity, you don't have to pay the fixed dividend, but they expect it. You're putting yourself risk. So we need to be look around, and we have to think about when we make decisions. Okay, that's one option. Okay, then sources of finance. When we look, the amount of the risk involved in the reasons of the cash. So a project which is a less chance of leading profit is deemed to be more risky. So you have to make sure which project you will take and what return you will get. So if you've been given the option to invest in Shell and in Samsung, which one you buy? Which company shares you will buy? What do you think? Shell or Samsung, or you can say Apple? What do you think? The better price share, okay, which is fine. Let's say both are the better, same share price, assume. So you have both same share price. One is a Shell and one is a Samsung or Apple. Which one give you quick return? So Samsung will give you quick return, but because it's a technology. But Shell oil discover, sell it, you will earn profit, then they will pay you dividend. So, but this can be for the longer period of time, this for the shorter period of time, as long the technology is acceptable. So that's why we need to be make decision. The length of the time, requirement of the finance. So good entrepreneurial will judge the finance needed for and make the decision, or good investor in other way. Okay, so we can look around the short term and the long term. Short term, it can be overdraft, supplier credit, working capital management. It means you manage your supplier payments, your trade receivables. Okay, then next we can look around the long term sources of finance. Mortgage, bank loan, issue shares, debentures, retain profit. The profit of the previous year we retaining our higher purchase agreement. So these can be And always when you make the decision, you can look around how much is cost and benefit each. What effect will be? Maybe you get the mortgage in 2%, but if shares maybe cost you 10%. Yes, and other always look the tax elements as well. And other thing we call capital allowance. Capital allowance. If you have a lease have two types, finance lease and operating lease. Operating is like a rent. Finance is mean the day first asset is your car is your name. Logbook is on your name. So that's if you have a finance lease, you can claim the capital allowance from for the tax purposes. Maybe you can save a lot of in the first year in the tax, but not second year, third year. So you have to make the decision. If you are short of the cash to pay the tax, maybe this year you can claim the capital allowance and you don't have to pay the tax to tax authority. So always we need to look around the options. Huh? Okay. So if we look appraise the appropriate sources. In the short run, business can raise the finance through overdraft. Overdraft is very flexible and can be arranged quickly. We can pay the little fees to bank and we can arrange. Depends upon our credit scoring. However, if the bank choose to withdraw it, bank can withdraw anytime, can be trouble for us. Bank loan is more formal arrangement and you have to be a fixed rate there. Okay, working capital management, as we discussed, working capital is the capital available conducting day-to-day business of operation. So normally excess of current asset, our current liability. Always we need to look around. Working capital management is all aspect, both the current asset and current liability. We have to be minimized, less risk. So we have to manage those. We have to manage these and we have to manage these. So that's the difference is working capital. So always we need to be make sure we manage our working capital. Okay, as we discussed sources of finance, even we can divide it medium term and the long term as well. So long term we discuss, medium term can be bank loan, even leases can be medium term. Maybe we can say 1 to 3 years can be medium term, more than 3 years, depends on the nature of the business. Short term normally we cluster at the less than. Okay, invoices, if we have factoring, we can give the invoice to the different companies, like you have to receive £100 from someone, don't have a cash or you give the invoice to the lending companies and they can give you 80, £90, depend upon what sort of business you're in. Okay, so each sources of finance, bank draft, we have advantages and disadvantage. So you will see there, this is the good ways to cover the period of money, and then of course interest is repayable on the amount withdrawn. Then we have a borrowing. Of course, we can look around clearing banks, retail bank, merchant bank, and we can borrow money from them. We have bank will lend you money and only if they repaid within the reasonable time. So always we need to look around the time, how long we required. Additional, if it's a partnership business, maybe we can add additional partner into business or even in the company, or they can be become owner in the company to shares. And then of course, so we need to be look around what control, what effect will be. Okay, issue shares, we have advantages and disadvantages as well. Doesn't have to repay it, no interest involved. That but is profit will be paid out of the dividend. Yes. So as I earlier mentioned, leasing can be one sources of finance. Lease has two types, finance lease and operating lease. So operating lease and the finance lease. So you have to decide which lease you will go. Hire purchase is like a rent. You purchase on the hire purchase agreement and there we can pay. So we have advantages and so business can use up to date, the equipment immediately. If the payment is separate, the period. The disadvantage, this is expensive method of the source of finance. Okay, mortgage, it's for longer period of time, 25 years, 10 years. So like mortgage on a house on mortgage. So business has used properties payments to spread over the period. So disadvantage is very expensive method compared to the buying with the cash. Of course, your cash, if you have a cash, you're a king. Yes, cash is the lifeblood for business. Trade creditors. So that's you need a good negotiation skill. You have to find the supplier, those give you the for the longer period of credit. So if you have a good reputation as a company and in the past we used to make the payments on time to our suppliers, we can. So that's the advantages. These are and disadvantages. So business can sell the goods first and pay for them later. So that disadvantage discount given for the cash payment, but not on the credits. So that's that lot of company at the businesses say if you pay in cash, we'll give you discount. Okay, government grant. Always we need to keep in mind. Sometime government grant, like in UK, if you want to be do export business, government grants available. If you bring 20,000 euros, so suppose you can get some government grant. You have to do a bit research on it. Okay, venture capital. Venture capital mean different venture company. They can pool into different project and they can do the funding for it. And that's we can look around and this is very popular in the UK. Big project like electric, like we in a process of fast train service from London to Leeds, in the 3 hour journey will be reduced to 1.5 hour, even less, so through venture capital. Okay, so the factors affecting the choices. So what factor affect the choices? Yours. The purpose you have to look around. The time period you have to look around. The amount you need to, and ownership and the size of the business. Yes, the sole trader partnership, limited company, public limited company, because you can issue the shares as well. Not every business can issue. Okay, next 4.3, we're looking twice the sources of finance and range of criteria and the cost and the risk. Okay, so with last lesson we discussed about capital expenditures and revenue. So you have to make a decision. Is it you buying asset, which is like property, plant, equipment? That's your capital expenditures. It means it's better to be you go for the long term sources of finance, because the property you use number of years. Of course, if you don't have a, but that give you, yes, and you carry on paying little, but of course interest will be involved. Okay, revenue, expense day to day. You require to maintain the asset in the same condition. That's the revenue. You always look around the capital income. Capital incomes come, you sell the asset, you earn the profit on it. That's your capital income. Revenue is your normal business. You buying and selling goods. That's your revenue income. So that will carry on. Okay, anybody, any question, please? If you have any question, you can ask them, guys. Okay, so we need to look around the sources of finance. These are all being summarized. We can look around the capital market for the long term for and money market for the medium term and the short term sources of finance. So money market and capital market can be divided into, and we can look around the sources of finance within those markets, like all the here we discussed. Okay, so then next we looking when you there are a lot of models to be look around, X theoretical price, what effect will be if more shares will be in circulation, the existing shares value or the dividend, existing shareholders feel, their value of the shares is drop because the company issue more shares and the dividend will be divided into more shareholders. So we can look around the effect of a theoretical X price, as well. So other debt versus equity owner business and the voting right. Debt holder are the higher priorities than the shareholder risk. Debt is low risk for the debt holders, higher risk for the company. And equity higher risk for the shareholders and lower risk for the company. You will see there the debt holders will accept the lower return due to the lower risk, and equity holders share want higher return due to the higher risk, because that's why is gearing ratio. Always we're looking in the business what is the gearing ratio, debt divided by equity, which we calculated in our second lesson. So that we also keep in mind the ratio. We need to look around the what sort of the business, medium, small enterprise, and you can decide. Another, we can look around the weightage. Always we heard about don't put all your egg in one basket. Maybe we can go through some money through debt financing, some money through equity financing, because we can look around what is the weightage average cost, weightage average, what is the average cost. So this is the weightage average cost of capital formula, which we call WACC, weightage average cost of capital. And that formula is V is mean the cost of equity, VE cost of equity plus cost of debt, KE is the cost of equity, how much debt, how much cost. K is represent cost. This is value of equity, V is the value of equity, value of equity plus value of debt, and KE is the cost of equity, how much is cost us. And we do, and the cost of debt minus 1 minus T is the tax, because that's the post tax, and other is the after tax. So that's we also keep, and we can find which one is the weightage average. So we want to be weightage average cost, we want to be reduced, and we can put in the formula, and we can use the formula to calculate. Okay, then we have a video is about the sources of finance, different sources. So guys, it's good to be, please go through. You've been given the 2 articles to read about the sources of finance, which is published by ACCA, Association of Chartered Accountants. So that is good, and is a quiz as well, sources of finance. So please, you can do your own. Today I'm not doing with you, I'm not taking a test, but you can do and play with it. That also help you. Okay, so anybody, any question? Okay, so today lesson we can recap. Any question first, please, before we recap? Anyone? No question? Today lesson is more straightforward, we can say, but always you need to keep in mind that what is the base rate, what is the, how long, what is the purpose, which option. You have to keep in mind all possible options of sources of finance, and then you decide which one is the best. So guys, please, always good to be read the journal articles, which I'm always copying the links there, and go through. And in next lesson we'll go through LO5, and the following lessons we'll go through our assignment discussion. So if you have in between any question, please drop me email on my email address, and I hope speak to you all during our next lesson. Thanks for listening and attending. And if you no question, we'll keep up to here then. Okay, thank you. Bye bye. Have a nice time. Anyone, any question? If you have, please. Okay, no question. Enjoy. Yes, speak to you all during our next session then. Thank you. Bye bye.